All right, good afternoon, ladies and gentlemen. Warm welcome to this week's weekly market review. My name is Benjamin Goh, the Head of Research and Investor Education here at SIAS. With us is our Senior Technical Analyst, Sunny. So we're going to be bringing to you some key highlights, what may be happening, what is happening in the market this week, some key things to look at. Sunny will be talking a little bit about the US earnings seasons. But I'm going to kick off with the most important slide, obviously, is the disclaimer. So SIAS is a registered charity. We're not licensed by MAS. So whatever that we talk about today, especially for specific stocks, cannot be misconstrued as a recommendation. So do see a licensed financial professional before taking any kind of action in the capital markets. Before we get down to the content, a couple of admin announcements. The next ASEAN session is on the 16th of August. This is again on the Wednesday evening. So this is limited or rather exclusive to SIAS members. So please use a QR code to choke your seats to make sure that we have got sufficient bandwidth to do this. Next is obviously the Google review. Do give us a 5-star rating here. So I'm going to be a very thick skin and give us a 5-star rating. If you do like us, like our content, please give us a highly rated. That will be very helpful. And if you're not a SIAS member, then you can still sign up for the membership that's going for $1 a month, $12 per year, which is a ridiculously cheap price, I think. And that will grant you access to our popular ASEAN session, which is held every, I think it was the 3rd or 4th Wednesday of the month, where you can ask any questions. So use the QR code to sign up for our membership. Now, I'm going to be covering some of the key highlights on the technical analysis side, and then after that, Sunny will be talking about specific stocks. So there's been a couple of things that happened over, there's been development over the last few weeks. A key milestone has been reached in the last week or so. The S&P 500 has broke out of its key 76% Fibonacci retracement. The reason why this is a key resistance level that has been breached is simply because it is 100% true in all other situations when the market is recovering from a downturn, that if the market breaches or breaks out with 76% retracement level, 100% of the time it will go on to start a bull run. So take it as what you will, but going back to the 100 plus or maybe 100 years of data from Dow Jones as S&P 500, this has happened all the time. So in all the market corrections, when the market was down about 20% and came back from the trough, once it hits this retracement, normally, or rather not normally, but 100% of the time, it went on to start a new bull run. So take that as you will. Again, we're not recommending anything. The other thing I want to look at is obviously the breadth of the market. We do have about 75% of the component stocks at S&P 500, which are above their 200-day moving average, which is kind of nice. If you look at the second panel here, the one in white, you can see the 75.2%. What you can also see is that the improvements in the broad market advance is not consistent. So it's not perfect, but at least you can see that there is a uptrend over here. And of course, what we're going to see is to have this number here move up to the 80 plus 90%. That'd be fantastic. The RSI is the last panel on the bottom here. So at 68, at the 68 mark, obviously is very close to the hypothetical rule of thumb 70 mark, where the market is deemed to be in a overbought territory. So we're not there yet. But it is kind of nice. So it kind of supports the broad narrative that the market is on the uptrend and a little bit healthy as well. Now, I want to again touch on one other item. So a couple of weeks back, we were talking about the market, or S&P 500, which was going up, but mainly driven by the top 5 or top 7 big tech companies, and we were looking at it from a whether or not that market advance was robust. Happy to say that when I look at the same analysis, not just on the S&P 500, which is market cap weighted, but when we look at the S&P 500, which is equal weighted, that means every one of the 500 stocks have got equal weights. They show the same thing. So the S&P 500 equal weighted is very close to the 76% retracement mark, just slightly below it. And it looks as though it's going to be breaching it in the next week or two. And again, when we look at the breadth indicators, broadly in line with the S&P 500 price weighted. So it's not just top 5 or top 7 tech companies which is moving the entire market up. It is really a more or less a broad-based advance. So since that week, in the last 2 or 3 weeks, we've seen a huge improvement in the advance of the all sectors, roughly all sectors in S&P 500. So that's great. Now, I want to talk about 3 key sectors. This will be the semiconductors, home builders, as well as transportation sectors in the US. Typically, these are the 3 sectors that will move first and kind of pull the entire US economy forward. If you look at the first and the middle panel, the white color and blue color one, the semicon as well as home builders have reached their highs, or rather have reached their highs. Right, so again, this is a broad indication that these two sectors are moving ahead and have show strength in the market moving forward. The laggard here is the transportation, which has not gone past its previous peak, but again, as you can see in the recent few weeks or so, it's been advancing quite nicely and is broken out of this downtrend. So 2 out of 3 leading sectors showing really good strength here. One other thing I want to look at is the ratio between cyclicals as well as staples, or rather staples divided by cyclicals, and the other one will be the utilities divided by the overall S&P 500. So again, happy to note that you have got the cyclicals gaining strength. As you can see, the blue color line is on the downtrend, so which means that the cyclicals are advancing faster than the staples. And if you look at the yellow color line below, you can see that the utilities are gaining, or rather are losing ground to the overall S&P 500. That's why it's a downtrend. So all these again suggests that the growth or pro-growth and cyclical sectors in the S&P 500 are basically gaining strength at the in favor of the defensives. So again, that's a good indication. All right. The last chart I have is an analysis of the typical behavior of the S&P 500 after the Fed announces a pause in its interest rate hike. So obviously, this is not the first downturn in the economy. Every 8 to 12 years, there's always a recession, so on and so forth. That's when the macro policy changes. The Fed will lower interest rate. Then when it gets to the peak, you increase interest rate, so on and so forth. So there's a wealth of data here. So looking at all the peak to trough cycles, historically speaking, after the Fed pauses its interest rate hike, this is kind of the behavior of the S&P 500. The yellow color line is the mean, which is basically the simple average. So as you can see, 90 days out, the yellow color line, 90 days out after an interest rate pause, the S&P 500 advances about, about 8%, 9%. So that's the yellow color one. Then, of course, you've got the max and you've got a mean as well. All right. So the average is about 8% or so, which again bodes well and supports the overall fundamentals, the macroeconomic theory that we have. So Sunny is going to be talking a little bit more about interest rate hikes, but if we do hit peak interest rates in the next couple of months, the next 2 meetings, then obviously this again supports the narrative that the S&P 500 has turned a corner, right? So you've got broad market indicators suggesting that it's more, it's the start of a new cycle. You've got historical data that kind of supports the narrative as well. So I think we are going to be quite excited to see what happens in the next few months. All right, over to Sunny.
Okay, thanks, Benjamin. So the stars seems to be aligning. Market seems to be pointing towards a much more positive second half of this year compared to the first half of this year. So just to add on a little bit of what Benjamin has shared earlier, the market seems to be spreading into a broad-based rally, because if you remember a couple of weeks or 1 or 2 months back, The rally is mainly led by AI stocks, big tech counters, and we are seeing now what Benjamin presented earlier, that this uptrend or this positive momentum in the market is spreading towards the cyclical as well. That means that overall the market is pretty healthy and going in an upward movement. So for me, as usual, I'll start off with the economic data first. So last week, we have a pretty light kind of economic calendar. We only have the retail sales number, which comes in at 0.2% versus the previous reading of 0.5%. And that was just slightly lower than both the previous and consensus as well. So retail sales a little bit are slowing down. Building permits also the same kind of a reading. 1.44 was the actual number. The previous reading was 1.49. Consensus was also same to the previous reading, 1.49. So these are two data that shows that the economy might be slowing down. But then what we know from last week was that the major part of attention was focused on the earnings calendar, which I'll touch on later on. But this week, there will be big economic announcements to be made. First is the FOMC meeting, and then the Fed rate decision, which we expect that the Fed is going to raise the interest rate by another 0.25% to 0.55%. To 5.5%. That is 25 basis points higher than the previous month's decision at 5.25. So I'll show you later on CME Fed Watch 2 that this 25 basis point hike has already been fully priced into the market already. And hence, if we see a 25 basis point hike, that would have a minimum kind of impact on the market. And of course, on Friday, we have the core PCE price index, another set of data which the Fed will be looking at as well in their fight against inflation. So that is expected to come in at 0.2, which is lower than the previous reading at 0.3. So if that is in line or in line with what the consensus are saying, that means that we are also seeing the core PCE price index coming down month on month. Okay, so this is the economic data that will be driving the market this week. The main one will be the FOMC rate decision. So next, the CME Fed Watch 2, which calculate the probability of the interest rate hike based on the futures pricing. So the next meeting we have is on 26 July. So the announcement might be made on 27 July, but before that, maybe there might be some volatile market movement. But what we can see over here is that you can see this. We are now at 5.25%, and we are going to bring it to 5.5%. And the probability is already standing at 99.82. So it's pretty much 100% baked into the prices right now. So Ben just now said that we might be close to the peak interest rate. So I just want to remind and look at the dot plot chart again. Okay, so where do we expect the peak interest rate to happen? So you can see that most of the consensus is around this level. The blue colored dot over here, if I'm going to draw it over, is just slightly above the 5.5%. So maybe this could be one or the last one or the second last of a rate hike that we'll be seeing for this year. And as we reach that, what Ben mentioned earlier, it could signal the start of another bull run once we have reached peak interest rate. Okay. So of course, all attention last week and this week will be on the earnings calendar. So last week we have Bank of America posting their result as well. Some of the big banks, including Morgan Stanley, Charles Schwab, big financial institution, Bank of New York Mellon, you can see all the earnings per share is in green. So that means that economy is doing well. Corporate America is also doing well. Hence, that's also explain why the index has been rising higher and higher in the past few weeks. And then on Wednesday, you can see that Tesla also reported positive earnings per share and of course increase in revenue as well. But the earnings call, the conference call with the CEO Elon Musk was not taken in a positive light because Elon Musk chose to focus on the unimportant kind of data, which means that they are expecting further price cuts to Tesla vehicle prices. As well as the slowdown in production numbers due to the summer holidays, where analysts or the market is expecting Elon Musk to shed some light on what are the key projects that Tesla is looking at going forward. One of them would definitely be the Cybertruck kind of a production numbers or forecast going forward, since it has been delayed for quite a few years. So Tesla, I'm not sure if Elon Musk is trying to sort of slow down the rate of increase in Tesla share price so that he has more time to get back in. That's just purely my opinion. So take that with a big grain of salt. But definitely the numbers look fantastic to me. And this pullback might actually be an opportunity to get back into Tesla as well. So Netflix numbers was also quite positive. As you can see, revenue above the forecast and also above the previous numbers. Earnings per share also higher than the consensus and also slightly higher than the previous quarter reading. So this is also a positive number. However, the Netflix figures also had a pullback. But then I think that the positive note to take from the Netflix earnings report was they have been clamping down pretty heavy on the sharing of the Netflix account, and that have contributed to another 6 million accounts for Netflix. And they have highlighted that they have actually published or given notification to account holders, close to 100 million account holders who have been sharing their password. So we can see that the growth of the subscriber base, or more people with subscribing to Netflix, might be in line for the next few quarters, and that is also in line with what most of the analysts are saying, and they have sort of raised the buy call, the target call for Netflix in very broadly to most of the consensus, to most of the analysts rating on Wall Street. Okay, so this week I'm going to fast forward down. So this week, tomorrow, we are looking at Microsoft and Alphabet, the two biggest tech giants reporting their earnings. Microsoft, we are expecting the earnings per share consensus at $2.55 against the previous reading of $2.23, with revenue forecasted at 55 billion versus the 51 billion previously. So you can see even the forecasts are also projecting that we are doing better than the previous quarter. So that could signal to us that corporate America might be sort of in a pretty healthy state, and that could be the bedrock of pushing the market higher again in the second half of this year. Okay, and then the next one will be Alphabet. Alphabet earnings per share is expected to come in at $1.34 versus the previous reading of $1.21. Revenue is forecasted at 72 billion versus the 69 billion of the previous quarter. Okay, so that means that also forecasting that Alphabet will do better as well. But if you want to know which one of these two big tech is going to have a better opportunity in terms of the technical perspective, you can look at the other video, the technical insights video, which I covered these two stocks on their chart movement in the recent history. Okay, so for the weekly market review, as usual, I'll go through the indices. So first, let's look at the Dow Jones Index. So as you can see over here, I want to zoom in close to this past 10 trading sessions, 10 consecutive trading sessions. The Dow Jones Index has closed in a positive light. So although you can see that on Friday, we only managed to close in the green by just 2.51 points, and that in terms of percentage, only a 0.01% increase. Why is that significant? Because this marks a 10 consecutive positive close for the Dow Jones Index, which was not seen since the 2017 year. So this is a sort of a sign to me, which is in line with what Benjamin said earlier. We might be in at the beginning of a new bull run. Okay. However, that being said, I also would not advise any traders or investors to chase the market. Always look on the chart itself to say look for a pullback before getting back in. Okay. So the Dow Jones Index, what are the key levels? So we closed at 35,227 last week. So we are looking at the next level of resistance. I'm going to zoom out a little bit. So you can see that the next level of resistance will be this level over here, which is the April period of last year, and that is around the 35,492. So I have no doubt that this will be a resistance level, but looking at how the strength of the recent movement, it might be broken above, and it might provide the next support level for the Dow Jones Index going forward. And if let's say the theory or the investment thesis that Benjamin and myself has been talking about is likely going to be true, then the next level of resistance that we will see will definitely be the 36,900 level, or we can round it up to the 37,000 handle, and that would be what we see last year at the beginning of the period. That was the peak period before the market actually went down quite a bit. So if we are able to reach this level, then we would have largely erased the losses for the whole of 2022. And that also boils down with the theory that the market is actually on a new phase of a bull run going forward. So do look out for this level. Okay, if we have a break above the 35,490 points level, this could become a resistance support level. However, if we have a pullback on the Dow Jones Index, definitely the first support will come in at 34,700, and then the next support will be the triple top that you see this year at 34,281 points. On the indicator side, MACD indicator is showing pretty much of a very strong kind of momentum, with the MACD line diverging away from the signal line, and the MACD histogram also expanding upwards. That means that momentum is increasing. However, on the RSI, the latest reading is at 71.52. So this is above the 70-point overbought mark. and that suggests that we may see a pullback. Hence, I'm going to read deeper into the RSI indicator to see what happened the previous time when it hits above the 70-point level. Usually, you have a plateauing kind of a formation before a pullback occurs, okay? So as you can see over here in the October period, okay, we have a peak of the RSI indicator somewhere around here, referencing the resistance over here. And then RSI sort of stayed elevated around this level of the 70 point. And hence we can see a peak over here. However, when the RSI starts to pull back towards the 50-point neutral zone, we can only see that the index gone into a consolidation mode and not in a big pullback. So if that is the case, then definitely the RSI, if it's going to stay elevated, of course, it will mean that there might be some risk and near-term resistance around the 34,490-point level. However, if it pulls back towards the 60 or even the 50-point level, that would be a healthy level to get back in on the Dow Jones Index. Another reference that you can take note is the 20-day moving average. For any uptrend, we would want the candlestick of any securities to be using the 20-day moving average as a support, and that is currently the Bollinger Band basis at 34,300, which coincides with the triple top formation that you see over here as well. So this would be a very strong support level for the Dow Jones Index. Okay, next, let's move to the S&P 500. Okay, so this is the S&P 500. You can see also pretty much very elevated. The next resistance level that we are looking out for the S&P 500 would be the April or the end of March high as well. And that is around the level of 4,637 points, with the upper bound of the Bollinger Band just slightly lower at 4,625 points. S&P 500 also closed in the green last Friday, up 1.49 points or 0.03%. Okay, so if the earnings season is going to be positive as so far from what we can see, then it will provide another leg of an upside to the S&P 500 to move on to the next resistance level at 4,818 points, which is what we see at the beginning of 2022. So this is the level to watch out for the S&P 500 for a major resistance to happen. On the indicator side, you can see the MACD indicator. Although we see some kind of a converging signal from the MACD line towards the signal line, we do note that both the MACD line and the signal lines are way above the zero baseline of the MACD indicator. And that means that the uptrend momentum that we see so far is still pretty strong. The last two trading days, we also see a bit of a pullback, but that's just a minimum kind of a pullback, I would say. So I think that with the elevated level of the MACD and the signal line, we are seeing a very strong kind of a momentum present in the S&P 500 index. And if a pullback happens, the 20 days moving average, the Bollinger Band basis, 4,452 points will be the first level of support, coinciding with a mini double top formation you can see over here on the S&P 500. The RSI has actually breached above the 70-point mark last week. Okay, that may also explain why the MACD histogram, the last two histogram bar, might have seen a bit of a pullback, because technical traders or RSI traders might use this as an indication that the S&P 500 is in a overbought territory right now, and hence they are trying to take profit and sell out some of their position, and we see a bit of a pullback on the RSI indicator. However, if that were to pull back towards the 50 and 60-point levels, that means that it will be another healthy kind of a reading, and we can say that that will be much a better conservative level to get back into the S&P 500. So support, the first one will be the 20 days moving average at about 4,452 points. The lower side, I believe it would be the trajectory that you see over here, connecting the low on March as well as May of this year. So this would provide a trajectory for the S&P 500 to continue the upward trend. And just below this, we have the lower bound of the Bollinger Band at 4,279 points. Okay, next, let's move to the Nasdaq Composite Index. So Nasdaq Composite Index, you can see we see a very sharp pullback last week. Okay, that is the main, I contribute the main reason to the reading of the RSI indicator way above the 70-point mark, because last Wednesday reading, we hit the 75.89 reading. So that is that's more than 5 points above the 70-point overbought signal. And also, we've seen the, like I said earlier, Elon Musk, the earnings call wasn't sort of a fantastic presentation, which is the high standards that the analysts have sort of a set for him. But what is his agenda of doing that, I'm not sure. But then I'm just looking by the numbers itself. I'm going to refresh those numbers again. Tesla numbers and Netflix numbers looks pretty promising to me. So this is telling me that fundamentally these two companies are doing okay. Okay, so these are the two main drivers of the Nasdaq Composite Index, no doubt. So the first support level, same thing, we have a mini double top formation over here, which now coincides with the 20 days moving average, the Bollinger Band basis at 13,800 points. So that will be the first support for the Nasdaq Composite Index. Below this, we have the lower bound of the Bollinger Band, 13,136 points. And of course, this is also the level that we have saw last year in August, which has now found confluence, or maybe, yeah, which has now found confluence and provide another level of support. So this would be a pretty strong support level for the Nasdaq Composite Index. Now we have pulled back to this level already now, which is at the 59.88 level for the RSI reading. So that means that we are back into the healthy territory again, and we have some gap above the 50-point neutral mark. So if let's say a pullback happens towards the 20 days moving average or the low bound of the Bollinger Band, that could be another signal for traders and investors to get back in to ride the wave up this green uptrend line for the Nasdaq Composite Index towards the second half of this year. Okay, so I'll just do a quick take on the Hang Seng Index, the STI as well. So we can see Hang Seng Index on a downtrend this year. However, we can see that this downtrend has been broken out of quite a few times already since the middle of June. And I've said that this lower point that I see in March this year was actually would likely be the low for the Hang Seng Index for this year, and we could see a rebound going forward. And then we have a double bottom formation here, further reiterating that point. And today, although we have a 1.3% downward movement, we are still using the March low as a support. So I think the Hang Seng Index at the conservative level is going into a consolidation kind of a pattern forming. Okay, we are looking for some kind of catalyst, whether in the form of a government stimulus or even the big tech announcing some of the big deals going forward. That could be the next catalyst for the Hang Seng Index. But this consolidation looks healthy to me for an accumulation to happen, and then from there we can push towards year-to-date high at the 22,700 level. But of course, below that we have two resistance levels to watch out for: 20,800 as well as the key 20,000 level, which is the upper bound of the Bollinger Band, now reading at 19,696 points. So MACD indicator, I would say the trajectory of both the MACD and the signal line is pretty neutral, parallel to each other, and it looks like it's going to be sideways movement, and hence you can see that it's not much of a reading that is going to give us any indication. RSI is slightly weaker. The reading now is at 45.56, 5 points below the 50-point neutral mark. So that is something to watch out for traders who are trying to go long on the Hang Seng Index. Okay, we would not want the RSI indicator to move down too much. That will mean that the momentum is actually weakening. We want to let it hover around the 50-point level, or at least stay above the 50-point level for any uptrend to occur for the Hang Seng Index. Lastly, I'll cover the STI Index. So STI Index has broken through a key resistance trend line. So connecting the high in January, April, and then was tested in June as well. This level has already been broken through for the Swiss Times Index. So that means that the downtrend has been sort of rejected already, and we may be moving to another phase of the market, whether it's going to be a sideways movement or going to be an uptrend. We will have to see as more data or as more indication comes out from technical indicators as well as the charts. So the support line that we are looking at for the Swiss Times Index will definitely be connecting the low of the October low and the March low this year, thereby forming an uptrend line, which you see over here, which was breached somewhere in the early part of July, but we have a pretty sort of a strong rebound and gap up on the STI Index, and now we are back above that level. So if let's say the STI Index were to have a pullback, the support level that I'll be looking at will be this uptrend line in green, which may also be in line with where the December low is, the consolidation period of the November-December period last year. And if the 20 days moving average or the Bollinger Band basis were to catch up, that will provide another level of support for the STI Index going forward. So still looking pretty neutral to positive for the STI Index. So last few days, we have a pullback on the MACD indicator. However, you can see the gap and the trajectory of both the MACD and the signal lines are still sort of having a big gap between both of them, and both of them looks to have an upwards trajectory. The angle of attack looks to be facing upwards. That means that the movement of the candlestick in the STI Index is likely to be moving upwards because they are both above the zero baseline on the MACD indicator, thereby reaffirming that there's still positive momentum in the STI Index, although the last two trading sessions says that the momentum might be weakening. On the RSI, we have a sort of a pullback. The last Friday reading, we saw it go to a high of 67.44. The current reading today that we have on Monday is actually 61.20. So a slight pullback, which is still in the healthy zone. So that's thereby reaffirming the MACD indicator that we still have a pretty healthy, strong uptrend momentum present in the RSI index as well. So thereby, this MACD and the RSI are confirming each other that we have positive momentum in the Straits Times index. So the pullback might not be too bad, and then hence this level where we can see the December low would actually be the first support level, 3,200, as well as the low bound of the Bollinger Band at 3,213 points will provide significant support for the STI index. So that is all I have for this week. Benjamin, have anything to add?
Well, I just want to say that we've waited a long time, about 7 to 8 months for this moment. So for the longest time since the beginning of the year, we said that the second half of 2023 is where the I guess the recovery should happen. So we are seeing some indications of that's already happening. Obviously, the data is not perfect, but it never is. But there's really more upside compared to downside. You know, and it's not just about the technicals, but also the valuations. So the earnings season in US is not as shabby as we thought it would be. Actually, it's pretty good given the circumstances. So we do have a couple of wild cards, what's happening in the Ukraine, for example. But the other stuff is kind of less. Well, that's one. Two is, of course, you know, the credit situation in the US may deteriorate. Not really sure. But all indications is that they still have got that issue under control, right? And we already know what's happening in China. So the slowdown has already been priced in. It's mainly affecting the Hong Kong as well as the mainland Chinese market. But for the rest of the world, it looks like we are looking at the green shoots. All right. So thank you very much. We are happy. Hopefully you are happy. And next week, we're going to have a treat. We're going to have an external I guess, guest speaker. This person is from Tiger. And I guess, you know, it's always good to have a diversity of opinions. So we'll be eager to see or hear his views on what's going to be happening in the market in the next few months. So do join us next week for the weekly market review. So thank you very much and have a great week ahead.